Hello, sir.
Vidvat?
Yes, sir. Good morning, sir.
Okay, let me just, I'm not able to hear you, so I'm on mute basically. Yeah,
Okay.
now I can, yeah, my voice was absolutely at low.
Okay,
Fine.
sir. Can you hear me now, sir?
Yeah, yeah, I can hear you.
Okay. Okay.
The problem was at my end only because I had
Okay.
just,
Okay.
made it silent.
Right. Right. Okay. Sir. Okay.
So you are at your home in which place?
Chennai, sir.
Huh?
Chennai.
Hyderabad, Chennai?
Yes, sir.
Okay, okay, fine. So go ahead, please. Now you have done a valuation of a company, is it?
Yes, sir.
And you're a BMS student, isn't it?
Ecofin student, sir.
Huh?
Ecofin. Economics and Finance.
Economics. Okay, okay. So why
Yes, sir.
your voice is a bit low? Let me just. Uh,
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 is it better now, sir?
it's yeah, it's better now.
Okay, I'll keep my beat like this. Yes, sir.
Yo. Okay, so just show me your the company basically on the screen, your Excel sheets and everything.
Yes, sir. Can I? I'll present it, sir. 1 second, sir.
So I have just gone through your work. I think it's quite okay, and the basic
Okay.
concepts, everything is in line. Have you done any valuation course in your college or?
No, sir, I haven't done, sir. Not specific valuation, sir. I've done investment analysis and portfolio management course.
Acha, you have
But
done investment analysis and portfolio course. Who taught you?
yes, sir, Ashok, sir.
At Shivnadar.
Yes, sir. Sir, I've also done level one CFA. So
Okay,
over
so
there, I
that's
had
why
some.
you are
Yeah.
familiar with the valuation concept.
Yes, sir. Yes, sir.
Okay. So, so you have, some conceptual knowledge about that. So you have used that basically to calculate the value of the company. The value of the
Yes,
company,
sir.
it's a FMCG company, a contractual based FMCG company, isn't it?
Yes, sir. Yes, sir. Yes, sir.
Selling goods to, like Hindustan Unilever
Yeah.
and
Yes,
Pepsi and
sir.
other things, isn't it?
Yes, sir. Yes, sir.
Okay. This company is not listed in the stock exchange, isn't it?
It is, sir. It is, sir. Hindustan Foods is listed in the stock exchange.
Acha, this is listed company.
Yes.
Okay, fine. Now, I just gone through your all the, of course, I didn't get much of time, but
Okay.
there were a few, observations. If I remember, you have taken your cost of sales from, the cost from 8 to 70%. The margins have
Yes,
improved
sir.
drastically in a time bad in the second, 10 years, 5 years period.
Yes, sir.
Okay. First 5 year, you kept it same,
Yes,
almost
sir.
the average mean, and then you have dropped it to 70,
70.
increasing, the volumes, the margins for the company.
Yes, sir.
So, of course, you have cited the reason of the operating leverage because the
Yeah.
company's fixed cost is not going to go up and it is going to generate a higher returns for the company.
Yes, sir.
So that looks to be a little bit on an aggressive side. I don't know because the calculations I have not gone through. If you have shown those calculations, I don't know. So, but the cost of good, the margins going up, drastically in the last 5 years seems to be a little bit on a higher side. So you can just have you made three kind of scenarios: the base case, bull case, and bear case, and then
Yes,
taken
yes, sir.
average of like for base case take 60% as an assumption and 2020 for a bull for bear and the worst case scenario, and then do that calculation on a DCF basis rather than taking only the base case
Okay.
and then extrapolating that. So I think you have done that, isn't it?
Yes, sir. Yes, sir.
So take all the three, cases and assume a probability of 60%, for example, to a,
Okay.
a a base case and
Okay.
some lower percentages to the other two scenarios, and
Okay.
then combine them and calculate your projections on that basis. So that may look a little bit much better. Okay. So that
Okay,
will be
sir.
one thought. Okay.
Okay, sir.
And second is that, when I was going through your, before I come to the VAC calculation, you have what I, huh. Now, it's basically a contractual business where your, major customers are Hindustan Unilever and Pepsi and some others, isn't it?
Yes, sir.
So
Yes,
there
sir.
is always a kind of, a risk to the company. It's a small company.
Yes, sir.
Okay.
Small company.
So, and it can lead to a kind of, any company, just doesn't give orders, so it can, shrink the business.
Yes, sir.
So, company either has to find some more, business partners to, deleverage that risk,
Yes.
or if it is not possible, then, assume some kind of a discount
Mm,
on your, sales product, so that you had to be a little bit conservative in this thing.
okay.
Assuming that in
Okay.
long run there is a possibility of some of the things may happen which may go some like headwinds may come basically
Yeah,
in the
yeah,
market.
yeah. Yes, sir.
So that needs to be factored in.
Right,
Okay.
right. Okay.
Then you talked about the WAC. Okay.
Yes, sir.
Now in WAC, the you have assumed basically the beta is 1.3, isn't it?
Sir, I got the beta value from ticker tape, sir.
Huh?
From ticker tape.
Okay, so this is for the beta of the same company, isn't it?
Yes, beta. Yes, sir.
Now, normally what happens is that the beta of the FMCG companies like Hindustan Unilever or say, I mean, any other company like Daba, they are always below one. It's kind of 0.8, 0.7, 0.6. But this is a contractual company.
Yes, sir.
So there is a lot of volatility, can be a lot of volatility in the profits.
Yes, sir.
So the beta seems to be okay, but it is uh, usually you take the higher the beta, it will throw up, more
More.
whack and,
Yes, sir.
pull down your valuation, isn't
Yes,
it?
sir. Yes, sir.
But 1.3 seems to be very conservative. Okay.
Yes.
So there is
Okay.
another approach called bottoms up beta approach. Have you heard of that?
Okay. No, sir.
So,
Uh,
bottom up approach beta is basically you look for, which is based, not based purely on the stock exchange numbers. Basically, when you calculate beta, you regress the returns of the market with the stock returns. Okay.
right.
So
Right.
on the
Okay, sir.
on that basis, you calculate the beta, and that has been
Okay.
shown in
Okay.
the sites also. Okay,
Okay,
which
sir.
is
Ha
considered to
ha.
be quite highly unreliable.
Right. Right.
Okay, because the beta
Okay.
can change drastically. Okay,
Yes, sir.
and
Yes,
there
sir.
is something called a concept called levered beta and unlevered beta.
Yes, sir.
Okay. Now, first of all, you have to calculate a beta of, say, at least, some companies which are comparable with this company. Okay. And you just go to again to I mean, screener or a site and, know about the beta of those companies. And they are all leverage betas. Okay.
Right.
So now what you do is that, you calculate the average of all the betas of all the companies. Okay, because
Okay.
average generally sanitizes kinds of ups and downs, because there will be always a higher beta, lower beta. So if you take an average of, say, at least 10 companies, okay,
Yes, sir.
which
Yes,
are
sir.
comparable to this kind of a company, I'll just show you.
Hmm.
I'll just show you. I did it.
Sure, sir.
I did it using the AI. Okay,
Okay, sir. Okay.
so you just find out those companies and calculate the average.
Okay.
So it will be called levered beta.
11 beta. Okay.
Now, from levered beta, you need to calculate unlevered beta.
Okay.
Okay. So
Hmm.
assuming that, if you have, those 10 companies, if you know what is the debt and equity component,
Yeah.
so calculate the average debt equity component and take out the debt portion of the beta.
Hmm. Hmm. Hmm.
Right? There's a
Yes, sir.
formula for that. I'll
Yes, sir.
just show
Yes,
you.
sir.
So you will have a unlevered beta.
Yes, sir.
Okay. Now that is the unlevered beta of this company, which is a similar company. Okay.
Yes.
Then take the debt equity component of this company which you are valuing. Okay.
Okay.
And convert the unlevered beta into levered beta again.
Okay.
Okay.
Right,
So
sir.
when
Right.
I did this, I'll just show you if I can just, I'll just show you
Sure.
my screen. Okay.
Sure,
I don't
sir.
know whether
Yes.
I'm just reaching to that place. Okay.
Okay, sir.
So just I'll be sharing that, to you.
Okay, sir.
So let me just find it on my system and then I'll.
Sure, sir. Sure, sir.
Okay. Okay, so just be on, I think just let me be. uh, Can you hear me?
Yes, sir. Yes, sir. I can hear you, sir.
Okay, so why I can't see you? Okay, so fine. So I'm not at the moment. I'm not sharing. So I'll just share. Okay. So that was one. Okay, from converting the to
Hmm.
this thing. Okay. Then the second point was regarding the first is regarding beta. Second is regarding the cost of debt. Okay.
Okay, sir.
So I think you have assumed 8.35 or something, isn't it?
Sir, Cost of debt I
I
calculated.
have calculated you have taken market value of the debt, but actually you have taken the historical value coming from the historical sheets, okay, not
Yes, sir.
the
Yes, sir.
market,
Book
because the
value.
market value is not available, isn't it?
Yes, sir. Yes, sir. Yes, sir.
Because it doesn't
I've
have
taken
any
book
kind of
value.
a bond which is trading in the market. So you
Yes,
don't know
sir.
what is the market value of the debt. So you assume the historical as the market value. You
Yes, sir.
took the interest cost and
Yes, sir.
divided by
The
the
book
loan.
value of debt.
So it
Yes,
came
sir.
to out 8.35 or whatever.
Yes, sir. Yes,
Okay.
sir.
Now, because this is because the company might have taken loans in some earlier era, or you can make some mistakes also while calculating, the debt. So the safest way is basically to calculate the cost of debt is by taking, the uh, what do you say, the current repo rate, okay,
Okay, sir.
which is around 5.5% now, isn't it?
Yes, sir.
And add about 2 to 3%, the credit risk of the company. Okay,
Okay.
fine. So based on that, you calculate the cost of debt. Okay,
Okay, sir.
that means the government, first of all, you can even take a 10-year government yield, which is close to about
Mm.
6.3%. Okay, fine. So this is a risk-free rate. Okay.
Yes, sir. Yes, sir.
But as the company is, like Reliance is able to take close to about 8%, 7.5% to 8%. If
Right.
suppose Reliance is a bond,
Yeah.
the market interest rate would be around 7.5 to 8% when they go for loans. Okay.
Okay.
So this company is a small company
Yes,
which will
sir.
carry a more risk,
Risk.
maybe
Yes.
3% above the
Okay.
risk-free rate. Or you can just, go and, check with AI. So it will give you
Okay.
a exact, some calculations. So
Okay.
maybe it will be around, close to about 9
Right.
would be a kind of a appropriate rate of debt.
Okay. Okay,
Okay,
sir.
fine.
Right. Right. Yes, sir.
So instead of taking a rate which you have assumed as the market value of debt, which is again not the market value of debt,
Yes,
actual cost,
yes, sir.
and you've taken the interest cost which the
Yes,
company
sir.
has already spent over the value of the debt. Okay,
Yes, sir. Yes, sir.
fine. So of course, if nothing is there, then that is the only right way. But
Mm.
now, since we know that there is a repo rate which is, which was around 6.5% about a couple of months back.
Yes, sir.
So
Okay.
RBI has lowered, given a repo rate down by about 100 basis point. So
Yes.
today the repo rate, or maybe you take, like government yield of 10-year rather than
Right.
repo rate. So a 10-year yield, which is around 6.3%. Okay.
Okay.
So even if you've taken your risk-free rate as 6.3 or 6.27,
Okay.
so add the premium,
Mm.
the credit risk of the company, okay,
Yes,
which
sir.
is normally, because the government can borrow at the lowest rate because it doesn't have any risk.
Yes,
So
sir.
as we go up, the risk increases.
Increases.
Like a
Yes, sir.
company like a AAA rated company will have the least risk. Okay. So you
Okay.
add 100 basis point to, for example, to the risk-free rate, and
Yes,
that
sir.
becomes the rate for that company. But this
Okay.
company should be close to about triple B plus kind of a company.
Sure,
Okay.
sir. Yes, sir.
Fine. So it will be around, around 2.5 to 3% over the government yield would be
Yes, sir.
more appropriate. Okay.
Okay,
Like
sir.
6 plus
Got
3
it.
becomes 9, and 6
Okay.
plus 2.5 becomes 8.5. So
Okay.
you are
Yes,
very
sir.
close to that. So it
Okay.
should be
Okay.
between 8.5 to 9, and you can take, you should make some sensitivity analysis also.
Okay,
That
sir.
means you assume various kinds of scenarios. Suppose, if the interest rate is 8.5, if it is 9, then how the
Mm.
valuation looks like.
Right. Right.
Similarly, your risk-free rate, which is around 6.3 or
Mm.
6.27, it's exactly, that should be the rate, because I checked the, 10-year bond rate. It's close to about 6.31.
Yes. Yes, sir.
Okay.
Yes.
Now, because you are calculating the value of the company in Indian rupees, okay,
Mm.
and
Mm.
not
Mm.
in US dollars or other this thing, then you should always take the country risk rate also. Okay,
Right.
fine. That would be the rate of the top companies in the world, or top country in the world, like
Do-
triple rated country. Suppose the rate is around 4%, so you add about 2 to 3%, kind
right.
of a country risk,
Okay.
kind of a default risk. So add to calculate your risk-free rate. So that is
Right.
one way. Okay.
Okay.
But since you are making a valuation in Indian rupees, so your mechanism is absolutely all right.
Okay, sir. Okay.
Now coming to your market risk premium,
Yes, sir.
okay, which you have assumed around 7 point something, is it?
Yes, sir. Yes, sir.
Fine.
I've assumed the market risk premium I mean, I got that value from a website, sir,
Huh.
from a college website who was given the market risk premium of different countries.
Ah.
So for India, it was 7.5.
Yeah,
That's how
absolutely.
I
When I
get.
also checked, it was close to about between, close to about 7.5 to 8. So I
Yes,
also
sir.
calculated that. So that also number seems to be quite okay. So, I mean, you can always again make a sensitivity analysis. Suppose it hovers between 7.5 to 8. Okay.
Mm-hmm.
Suppose you take 8, your valuation will come down because your
Yes, sir.
discounting rate will go
Back
up.
is higher. Yes.
Okay. Fine. So because the discount rate, market risk premium also, changes over the time.
Okay, sir.
Fine. So maybe whatever is today may not hold true in say next 6 months or 7 months. There can be a little bit
Yeah.
volatility which may happen. So again, having kind of a two or three small variations, so you can make a sensitivity analysis. Okay.
Yes, sir. Yes, sir.
So you can even build in that. And then what was else in your valuation? Let me just open. Let me just see your market value of debt. Okay, cost of debt 8.3, risk free rate is okay, risk premium is okay. Beta I have already told you. Okay.
Yes, sir. Yes, sir.
Acha. Now you have taken what is the weight of debt? Debt is about 15%.
Yes, sir.
How much is the debt?
Eight 800 crores, 863
No,
crores.
in terms of percentage, I think you have taken some 12% debt and 80% some equity. If I just see your WACC calculations. Okay.
Yes, sir.
Just go to the sheet, so you will find that that weight of the debt is 12.54 and weight of equity is 87.46.
Yes, sir.
So the company is not highly leveraged, isn't
Highly
it?
leveraged. Yes. Yes, sir.
So
Yes,
a
sir.
beta of 1.31 seems to be little on a higher side. Only the business volatility will jack up the beta, but company is not leveraged too much, so that we should assume for a higher beta. Like
Yes,
a
sir.
15%, 10% of leverage is going to have a
Hmm.
little bit impact on the beta of the company. Okay.
Okay.
Like, when
Yes,
you
sir.
look at, Hindustan Unilever or Dabur, they are virtually zero, I mean, debt.
Yes, sir. Yes, sir.
About, 5 years back, they were not having any debt in the balance sheets at all.
Yes.
But now I have seen there is some amount of debt which has come, very small portion of debt which they
Hmm.
have, taken. So those companies always had a beta of 5.5, point 0.6. Okay.
Okay.
So if
Okay.
you add more debt, the beta also goes up. If
Yes,
you
sir.
make your business more riskier, then the
The
beta goes
beta
up.
goes up. Yes, sir. Yes, sir.
Since your company is little slight is riskier compared to the companies to which they are supplying, okay, because it is
Yeah.
based on
Contract
basically,
manufacturing.
yeah, it's a
Yeah.
contractual manufacturing. So that's so otherwise I find everything was okay. So let me just see what I further noticed. Okay, so I'll be just reading out certain things from the so when I just put your case and was looking at,
Okay, sir.
just hold on.
Yes, sir.
So one was you have to add some scenario probabilities, make a base case 60%, bull case 20, and bear case 20.
Okay, sir.
Okay. Then there is a client dependency risk. Basically, like HUL, Pepsi,
Yes,
these
sir.
are the companies, major clients of the. So there's all because business coming from them. So there is always a risk that should be factored in.
Yes,
Okay.
sir. Yes, sir. Hmm.
Ah, now coming to the terminal growth rate. Okay.
Yes, sir.
So you have assumed how much? 6.5, isn't it?
Six, sir.
6.
Yes, sir.
So how do you find 6? What was your, kind of assumption? How you arrived at 6?
Sir, my assumption was that all the product segments that they were doing, that they were focusing on, sir. So they were focusing more on ice cream, increasing footwear businesses
Just,
and everything.
I'm not able to hear it properly. Just put your this thing, yeah, again.
Hello, sir. Is it better, sir?
Yeah, yeah, you're audible.
Yes, sir. So the product segments that they were looking for to grow in the future, at least in the near future, were ice cream, were businesses like ice cream, footwear,
Okay.
cold beverages, and
Okay, just hold
and as
on.
such.
That is okay. That is absolutely right, whatever you have thought of. But
Yes,
actually,
sir.
the growth rate,
Yes,
uh,
sir.
it's a long-term growth rate, isn't it?
Yes, sir. Yes, sir.
It's a pretty long-term growth rate. Okay.
Yes,
It should
sir.
be, it should not be more than the nominal growth rate of the country, India.
Okay.
Fine. So the nominal growth rate of India is close to about 5.5%
Fine.
to 6%. Okay, fine.
Hmm.
Which is basically GDP plus the inflation.
Yes,
Okay.
sir.
So that should be the trick. Basically, when you're assuming, when you're making a valuation, if it's an American company, then the growth rate should be less than 1.5%, 2%, the
Right.
long-term growth rate, because there the
Okay.
economy's nominal growth rate is close to about 1 to 2%. In
Yes, sir.
India,
Yes.
we are growing at, GDP, a real growth rate is around 6. Our potential is about 6 to 6.5%.
Yes,
Okay.
sir. Okay.
And the long term may, I mean, come down a bit because, India can't grow at 6% forever.
Throughout. Yes, sir. Yes, sir.
Okay. So maybe after 10, 15 years, the growth may come to about 5% or something. So
Yes.
add inflation, kind of, and make it nominal. So it should be close to about 6.5%. So even your, I mean, growth rate seems to be okay. Fine.
Okay, sir. Hmm.
So it should be based on the nominal growth rate of
Nominal GDP.
India. Okay. Fine. The
Got
long
it, sir.
term.
Got it. Yes. Yes, sir. Yes. Okay.
So I'm just looking at again to this thing. So that was one. Other was basically, the cost and margin assumptions. So
Yes, sir.
CAGR's assumption declined to 70%. So model assume a
Yes, sir.
sharp drop of 87% to 70% in financial
Yes,
year
sir.
31-35 due to operational leverage, this thing,
Hmm. Hmm.
leverization.
Hmm.
So because of that, you have increased. So that seems to be a little aggressive, okay? Slightly. So we don't
Okay,
know.
sir.
So instead of making 70, you can just, drop make it from 87 to 75 or say, okay? Or make again a,
Okay,
a,
sir.
a model where, you have a base case and this thing, and then assume it goes to 70, it goes to 75, and then, 60% chances that we will get something like, say, 2020, maybe higher little this thing. So make that.
Okay, sir. Okay, sir.
So
Yes.
terminal calculation is basically, wait, okay. So the bottom up beta approach, which I told you, so that you need to
Yes,
apply.
sir.
Okay.
Yes, sir. Yes, sir.
So what I'm doing is basically I am just going through my file and just reading out from there.
Okay, sir.
Okay.
Okay.
So I'll just send you the recorded version, which will carry my file also. Okay.
Okay, sir. Okay, sir.
So I'm recording this session, so you can just also. Okay. Fine.
Sure, sir. Okay, sir.
So the nominal GDP growth is basically the real GDP growth plus inflation. Okay.
Yes, sir.
Fine. So nominal growth rate for this thing is recommended nominal growth should be between a mature FMCG, it should be 4.5% to 6%.
Hmm.
Contract manufacture, it should be between 5.5 to 6.5%. Okay.
Right.
What the
Okay.
AI is saying. Okay.
Okay.
Fine. For Hindustan Foods Limited, your company, it should be approximately between 5.5 to 6%. Okay.
Okay.
Okay. Then terminal growth is 5.5 to 6%. What this AI is saying. Okay. Okay. So beta, I have told you that beta you can always use the bottoms up
Bottom
approach.
up. Yes, sir.
Okay.
Hmm.
So I'm just, according to AI, 1.3 is reasonable. Okay, what you have chosen. Okay,
Okay.
but then I asked him, to calculate the bottom up this thing. So it is first step was, it had taken all the comparable companies. Okay,
Hmm.
like it has taken about, I think, couple of, three companies like Dixon Technologies, Amber Enterprise, and PG Electro Plast. Okay, and calculated their betas. Okay, the levered betas and their debt equity ratio also. And I'll just share this thing. Okay, just I'll share you with you my file. Okay,
Sure, sir.
I'm just opening up my file. Can you see my file?
Yes, sir. Okay.
Can you see this?
Yes, sir. Yes, sir. I can see this, sir.
Okay. Okay. I was just going through the beta one. Okay. So this is the long term. Can you see that long term?
Yes, sir. Yes, sir.
Okay.
Hmm.
So this is what it says. Okay. The growth rate. Okay.
Okay, sir. Yes,
So
sir.
for the this thing, contract manufacturers with moderate ongoing capacity additions, 5 to 6.5%.
Yes, sir. Okay.
Okay. So it is saying it should be between that. Okay.
Hmm.
Then we talked about, the beta.
Yes, sir.
Okay. So beta, it says, the conclusion was 1.3 is reasonable as you have done. Okay.
Hmm.
Because a small, why? Because it is a smaller size company.
Yes,
So
sir.
we have to choose our higher beta because it's a small company,
Yes, sir.
client concentration and capex funding requirements.
Yes, sir.
So what we did was I calculated these companies. Okay. Select the comparable companies. So
Hmm.
Dixon, Amber, and PG. Okay. So then it
Yes, sir.
calculated the beta for the levered beta from the market data. Okay.
Okay, sir.
So
Sir.
all these, levered beta, debt equity ratio, and tax rate. So you should have these three numbers,
Hmm.
and you will calculate the unlevered beta of each company. Okay.
Yes, sir. Okay.
So from
Hmm.
9.5, it came to 0.75 for Dixon
Sorry,
because of
sir.
the debt component being excluded now. For Amber, it was
Yes, sir.
0.85. From 1.5 was the
Hmm.
leverage.
Hmm.
0.85 is this thing, unlevered beta.
Hmm.
PG Electroplast, it was 1.2. It came to 8. Then we did the average of that. Okay.
Okay.
Then re-lever for Hindustan Foods. Now, here it has assumed 50%, I think it has assumed 50-50, isn't it?
Yes, sir. Yes, sir.
So, but you have to apply the right this thing because in your case it is about 12.5%. Okay.
12. Yes, sir.
12. Okay. So that means so the beta is going to be even less than 1.13. If you have lower debt, so it is lower down close to about 1. Okay.
Yes, sir.
So this,
Yes, sir.
have you understood? Because, in your case, it is around 12% debt
Yes,
and
sir. 18.
88% equity. But
Yes, sir.
while calculating the levered beta of this company is assumed 50% debt and 50% equity, isn't it?
Yes, sir.
So if you see, this is zero point 0.5 here. Okay. So in this case, it should be, 0.12 or something. Okay. So which will
Hmm.
make
Hmm.
the beta even lower than 1.13. So close to
Yes,
about 1.
sir.
Okay.
Hmm.
So 1.13 reflect the sector fundamentals.
Hmm. Yes, sir.
Your assumption of 1.3 is conservative because if you assume higher beta, it will throw up a lower valuation.
Yes,
But
sir.
if you make a less volatility, then it will improve the valuation of the company. Okay.
Yes, sir.
So, but you can always make a beta of 1.13 so that you can do a sensitivity analysis also.
Okay, sir.
Fine. Then I asked, is the cost of debt 8.3% okay for an Indian
Hmm.
small company? So he said that, the basic lending current market rates, company specific credit risk premium, loan tenor, and everything. So current rate is about 6.5% repo rate, which is actually 5.5%, not 6.5.
Okay, sir. Hmm.
Okay. So then I asked him that the rate is, you know, then I asked him current RBI rate is, please check. So it said current is 5.5. So which means that, so 5.5 plus around, 200 to 300 basis point add up. So it comes to basically 8 point is reasonable cost of debt, he says.
Yes,
Then,
sir.
uh, so it should, what it says finally is the base case should be 8.5 to 9%.
Okay. Right. Hmm.
And then you can even have a sensitivity analysis of 8.35 to 9 to 10%. Okay,
Hmm. Hmm. Hmm.
fine. So that's all.
Okay.
Is that okay? So what we have done is absolutely, okay.
Yes,
The
sir.
only thing is that we are just fine tuning some of the assumptions. Okay,
Yes, sir. Yes, sir.
fine. So what else?
Sir, I had a couple of doubts, sir. Like building the model, sir, I was finding it very, you know, this thing, like I thought I will have to mathematically explain, like you said, why my margin, my cost of goods sold from 87% is moving to 70%,
Yeah.
right? Sir, sir, I have a doubt. Like, how do I represent that mathematically, right? Or should I just
Mathematically,
use
because
intuition?
if you have made a forecast, now you are not making an explicit forecast from from that period for
Yes,
which you
sir.
are assuming it will go down to 70%, isn't it?
Yes, sir.
Fine, you can't because it's a pretty long time in horizon. So you can
Yes,
do
sir.
for the next 5 years, you can do a calculation.
Yes, sir.
But doing the same calculations, in the 10th or 15th year, it becomes almost impossible to do it.
Yes, sir.
Okay,
Yes,
because it
sir.
will be again based on a lot of assumptions.
Yes, sir.
Fine. But the only way is if you can calculate
Hmm.
explicit calculations till that period. Okay,
Hmm.
you can just try that one way.
Okay,
Okay,
sir.
or you can take the help of AI to generate
Okay,
a
sir.
long-term forecast.
Okay, sir.
Fine. So
Hmm.
that is the
Hmm.
only way out because you are assuming that the cost of goods sold will go down from
Hmm.
87 to
Hmm.
70% because of the
Yes, sir.
fixed cost. Okay.
Yes, sir. Yes,
But
sir.
now tell me, what is the current capacity of the company? Is it 100%, or 80 to 90% capacity it's using?
Sir, it's using many, sir. It has around 26 sites, sir.
Acha, then you are
And
adding some more capex also as you go along.
yes,
This
sir.
is always so that is a replacement capex or expansion capex.
Expansion capex, sir. Expansion
Okay,
capex.
expansion capex. So that means whatever is replacement is not going to enhance the capacity, but what is going
Uh-huh.
to be expansion? It will add more capacity because the orders will go
Yes.
up. Okay,
Yes, sir.
so uh, then in that case, the only idea is that is your the fixed cost.
Hmm.
Only when you assume that operational leverage will come into play is that if you are currently at 50% capacity, okay, and
Hmm.
you assume that you are not going to add more capacity, your sales will keep going and your margins will keep improving because you don't have to incur the more fixed cost.
Fixed cost, yes,
So
sir.
is that scenario can fit into your example to say that it will go down from 87 to 70? Only problem is that if you are already have a full capacity
Hmm.
because of like what happened during the COVID time, most of the
Hmm.
companies they were under lockdown. Okay, and they have everything. The capacity was full, but they were not manufacturing at full capacity because a lockdown period because demand was less. But as soon
Yes,
as
sir.
the COVID lockdown was lifted, because of the operating leverage, they started gaining more margins and more profits, and the
Yes, sir.
stock price of those companies also jumped. All the companies which has a lot of fixed cost built into their into their business, those
Hmm.
companies doubled in 1 year's time in the stock
Yes,
market.
sir.
But
Hmm.
all the
Hmm.
companies which were having a very low operational leverage,
Hmm.
because
Hmm.
most of the costs were fixed in variable in nature, those companies didn't go so much up. Okay.
Right. Yes, sir.
Now, if you apply all those logics and everything in your case of company, like the Hindustan, the company is Hindustan, isn't it?
Yes,
Hindustan
sir.
Foods.
Yes, sir.
Now, in this case, the company is already operating at 100% capacity. Okay, so it has already has the leverage fully built in.
Yes, sir.
So there
Yes,
is
sir.
no further scope of the cost going down in terms of percentage of the total cost. Okay,
Right.
fine.
Right. Right.
But
Okay.
only thing that we can assume is that the company is going to add more capex, and the company may take some time to ramp up to reach to the full capex, so that there will be always some kind of
Margin.
volatility in the margins. Okay,
Yes, sir. Yes, sir.
but if your today's margins are fully discounted for 100% capacity, then the cost of goods sold cannot go down below 87%, isn't it?
Right, sir. Yes, sir.
Maybe in times to come, what will happen
Hmm.
is that you will ramp up the capacity because there is always a lag
Hmm.
between the time when you put the capex and you start realizing your sales. So
Hmm.
only during that time you may experience some kind of a operating leverage, coming into play. Okay,
Okay.
you
Okay.
got me. You got me.
Yes, sir. Yes, sir.
So the operating leverage is not going to have an impact in your case, according to my
Okay.
plain reading. Okay,
Okay.
you said it will come down from
Right.
87 to 70%. That looks to be quite unrealistic assumption. if you look
Right.
it from the, whatever logic I have given to you.
Mm-hmm.
Okay. Just further explore, ask these questions from the AI. Okay.
Okay.
So you say that my company is, today at 100% capacity utilization. I'm going to add more capacity, ramp up the capacity.
Yes, sir.
I mean, will it my, the I'll have some
My,
operating leverage coming into play in my business or not? Okay.
yes, sir.
So sometimes you miss out something when we, think about, but you may get some more thoughts.
Sure, sir.
Have you got
Okay.
the answer
Uh, no, sir.
to your query? आपको समझ में
Oh,
आया ये
oh,
बात?
yeah, yeah. Yes, yes, sir. I got that. I got
Okay,
that, sir.
okay, okay.
Okay.
Is it make
So,
sense?
yes, sir. It makes sense, sir. It makes
Okay.
sense. Yes, sir. I'm understanding. Okay. So that I had that one doubt, and sir, again, sir, so for revenue, right? For my revenue projections, I used a segment-wise analysis. Okay,
You
sir.
have projected what?
For revenue growth,
Yeah.
I've used a segment-wise analysis, and I've done like
That is
within my
fine. You have
intuition.
assumed that there are various segments.
Yes,
Okay.
sir.
And for each segment, you assumed a separate growth rate, isn't it?
Yes, sir. Yes, sir.
Yeah.
Yes, sir. Sir, I've broadly taken, sir. So they have a lot of segments over there, and I've broadly taken for the segments that they have not mentioned any capacity expansions, mentioned any future enhancements. I have taken the growth of that segment as the industry average growth,
Okay. Okay.
and
Hmm.
so
Because you can't, you are only saying that, segment wise, what will be the capex requirement, how much more capex will be required per segment. You haven't done that detailing, isn't it?
uh, so what detailing exactly, sir?
No, no, I'm asking you that because for each segment, okay,
Hmm.
there are certain growth rates which we have assumed in terms
Yes,
of,
sir.
calculating your sales.
Yes, sir.
But in respect to the capex expansion for each
Hmm.
segment, you
Yes,
haven't
sir.
done a detailed calculation, isn't it?
Sir, I haven't done a detailed calculation, but I have. So last three quarters con call transcript I've read, sir.
Okay,
I've seen, and in that they have repeatedly mentioned only three sectors, sir. The ice cream which comes in the ice cream thing which comes in home and personal care, and shoes, sir.
hmm,
Almost these three things, and in home and personal care, and also OTC pharma, on the counter pharma, some pharmaceutical products, something like food care products, things like
okay,
those they have mentioned a lot, sir. So for all those companies, and they've mentioned capex also for that.
okay,
So for those companies, I have taken the industry growth rate, which I found online, and then I've added 4%, 3 or 4% more, because I'm assuming that since this company is at a very nascent stage, and so they have this thing called anchor tenant contract manufacturing place, or
okay,
where multiple products will come to them for capacity, for contract manufacturing. So in that case, I felt that the company will grow more than the industry, so I added a premium for that. I just wanted to know if whether this the how I'm thinking is correct.
See, because
Like,
you said a lot of things which I really couldn't get it. So what you can do it, you can
okay,
just put something on writing, okay?
yes, sir.
So that I can just go through whatever you said. I couldn't really pick up because of the voice,
Oh, so,
coming not
okay,
so clear. So you
okay.
can just, only your the area was that your capex which you have assumed going
Hmm.
forward. So is it right or is it wrong, or so you show me some calculations, or show me the the assumptions, how you have assumed capex increase in the coming years. Okay, fine.
Yes,
So
sir.
particularly for explicit period, you can always assume kind of a detailed calculations, but for balance you don't have to calculate that. So just put those thoughts on your assumption sheet and share with me, and then if I or you can just put that and seek the AI advice, or share with me also. Let's see if we can do something.
Sir, I didn't get you, sir. Sir, so what do you mean by explicit forecasting? Like,
Explicit forecasting is basically, when you make a forecast, fine,
right?
for calculating the valuation of a company. Say you are talking about, say, first you have the period which has already gone by, the historical period.
Yes,
Then you
sir.
make a 5 year detailed calculations. Okay,
Okay.
assuming what will be your all your costs and everything. So you make a line by line calculations. Have you done for the next first 5 years? You haven't done that, isn't it?
No, sir, I haven't done
So
line by line, sir.
normally, what we do is basically you calculate an explicit period where you calculate do a detailed calculations for the next 5 years. Suppose it is 2025. So up to 2030, you do a line by line calculations instead of just
Okay.
using your ratio analysis. Okay,
Right.
fine. You do that, put those numbers as if you're preparing a forecasted profit loss account of those companies. Okay, income statement. So do that.
Okay.
So that is called explicit.
Okay.
But
Right.
you can't do an explicit for a longer period, more than 5 years.
Yes. Yes, sir.
Even if you ask the management of the company, they can tell you about the visibility of the next 5 years. Beyond that, you say what will
Okay.
happen in the 10th year, 15th year. So that is an unexplicit period, okay, which you can't do. So you have to assume those growth rates, which you have done
Right.
actually is actually you have assumed a certain growth rates and calculated everything. Okay.
Yes, sir.
So you do that for the period which is longer duration period, okay, where you
Okay.
can't do explicit working.
Right. 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 Right.
So I
Okay.
think that we missed out that when you are making a DCF model,
Okay.
so
Okay.
you show the next 5 year detailed calculations.
Okay, sir.
Okay, fine.
Okay.
Your
Okay.
sales, your cost of
Mm.
goods,
Right.
your a breakup of your raw material or cost of
Right.
conversion, whatever possible. Okay, and then
Mm-hmm.
your administrative cost, your depreciation,
Right.
your selling and distribution expenses, your all those expenses, at least a broader line items should be calculated for each
Okay.
this thing. And for each broader calculation, you have more multi calculations on your side sheet. Okay,
Right.
so
Right.
you
Right.
just
Right. Right.
combine them and make a 5 year, in real time when we do it for
Mm.
companies, we ask, our team to make a complete next 5 year calculations as if we're
Okay.
making a real profit loss account based
Okay.
on assumptions. So
Okay.
assumptions are given by the management. Okay,
Right.
and the assumptions with regard to what will be the inflation, what will be the forex rates, or what will be
Mm-hmm.
the cost of power, electricity, diesel,
Mm.
whatever is required, okay, in the next 5 years. For each of the input we get the details, whatever is
Mm.
there, the cost
Mm.
of raw material. Okay,
Okay.
again, like for example, in this case, you are an FMCG, so you find out what is the cost, what is the major cost. Okay,
Right.
so those components, and then you try to find out what will be the cost of those each component, and plug in
Mm.
those costs and calculate the next 5 years. It's a very detailed
Okay.
exercise in
Right.
real life. Okay,
Yes, sir.
fine, but generally the analyst will not show that, when he is making a presentation.
Mm.
All his calculations will be at the back end, but he is going to show only the broader line items and show the
Mm-hmm.
numbers. Okay, so that is
Okay.
called the
Okay.
explicit period. Okay, fine,
Right. Right.
and you make a complete calculations.
Okay. So,
Whatever
so,
possible, it's not sometimes
sure.
possible to do each and everything, but whatever is possible.
Sure, sir. Sir, so the explicit forecasting, I have to do it for all the three financial statements or just profit and loss?
For all the segments, yeah.
Okay, okay. For all the financial statements, so balance sheet, profit and loss, and cash flow, I have to do, or
No, particularly more rightly for the income statement.
okay,
Okay,
okay, right,
fine.
okay,
Now,
sir.
and for other, of course, you have to know what should be your, because you have to calculate the depreciation. Okay,
Yes, sir.
fine.
Hmm.
So for that, you should have a complete depreciation schedule also. You may not make
Okay.
a balance sheet, but at least a depreciation schedule.
Schedule. Yes,
Fine.
sir.
A loan schedule.
Hmm.
Okay.
Okay. Okay, sir.
So
Right.
those things you have to do. I'll just share
Hmm.
one financial modeling video. Okay.
Okay. Okay.
So which calculates each and everything for the working capital, for everything, and for
Okay.
make it makes a 5 year a balance sheet and profit loss account of the company.
Okay.
So
Okay,
it's a
sir.
template basically.
Sure, sir. Okay, I got it.
So they are available on the YouTube. So I just picked up from there and I shared it with my students when I was doing this for some class.
Okay, sir.
Okay, or
Okay.
I bought a software for calculating those these things. So I have a software also. I will share you
Mm-hmm.
that. So
Okay, sir.
you plug in all the numbers, you will get desired results.
Okay, okay,
Okay, so there is one software which calculates where you have to tell what is the all the numbers you have to feed. Okay,
okay,
fine, some assumptions like what is your profit margin, what is your this thing. So basic this thing, and it recalculates your next 5 years balance sheet profit loss.
okay, okay, sir. All right.
That can be one.
Huh.
And another
Okay.
is an explanation of on a YouTube how to make a financial model. So
Mm-hmm.
I'll share both. You can
Sure,
just go through.
sure, sir. Yes, sir. Yes, sir.
But
I'll
give me
look
some
into
time
both.
because it is lying in my earlier laptop.
Sure,
So
sir.
I'm using a
Okay.
new one. So I have to just find out all these are available, or it will be on my drive. So I'll just share with you.
Sure, sir. Okay, sir. Okay, sir. For sure, sir.
Okay,
Yes, sir.
fine. Is
Yes,
that
sir.
okay?
Yes, sir. Yes, sir. Definitely, sir.
Anything else?
Sir, can you just give me 1 minute, sir? Can I just check
Huh?
my Excel? Sir, 1 minute, sir. Can I just check my Excel?
You can check.
Sir, I have one more doubt, sir. One more small doubt, sir.
Okay, okay. Let me know.
So for depreciation, right? I mean, sir, for depreciation, I first calculated the capex growth, sir.
Huh.
So for capex, what I used, I did regression between revenue and capex because
Your
see,
voice is not clear for calculating the depreciation.
yes,
Okay. So what we do is that when you make a depreciation schedule, you can calculate that. But you haven't done that. So you have assumed on the basis of your numbers, basically growth numbers only.
yes,
So
sir.
that is one way. That is also fine.
Okay, sir. So one doubt, sir. Okay, can you hear me properly now?
Can
Am I
you?
audible? Am I audible?
Yeah, yeah.
Yes, sir. So so how I calculate depreciation? I first. So can you hear me?
Yeah, yeah.
Ah,
Just be near to your this thing. Yeah, I can hear.
okay, sir. Sir, so how I calculated depreciation was that I first did regression between capex and revenue, sir.
Huh.
So I was able to forecast capex, and
On the
after that,
basis of revenue, you have forecasted the capex, isn't it?
yes, sir, yes, sir.
Okay.
And after that, I used the same capex amount and recent gross block. I've
Okay.
added it to capex and that's what I did, sir. So FY25 gross block plus capex is equal to FY26 gross block. So
Okay.
that's how I calculated gross block and depreciation. So so last so
So
last five.
what I'll do, I'll just go through your depreciation calculations. Okay.
Okay, okay.
And maybe today itself, I'll come back to you, or maybe tomorrow. Okay.
Sure, sir. Sure, sir.
So
Okay,
if
sir.
it's a better one, I'll just suggest you a better this thing.
Sure, sir. Sure, sir.
Fine. So just give me some time because I'm not able now, because we had a lot of, time we have consumed.
Yes, sir. Yes,
So,
sir.
I have, we have to go somewhere.
Sure, sir.
So
Sure, sir.
I'll
Yes,
just
sir.
go through your depreciation, this thing,
Done,
and
sir.
comment on that. Okay.
Done, sir.
Fine.
Done,
And
sir.
suggest
Yes,
you a
sir.
better way of doing it.
Okay, sir.
Okay.
Okay, sir. Yes, sir. Thanks a lot, sir. Thanks a
Okay.
lot for
Thank
your
you.
time,
Thank
sir.
you. Okay.
Thanks.
So
Thanks a lot,
this
sir.
is your final year, or there's one more year is left?
I've completed, sir. I've
Acha,
completed.
you have completed. Okay.
Yes, sir.
Thank you. All the best. Thank you.
Yes, sir. Thank you, sir. Thank you, sir.